I want to start. Let's talk though about Taylor Swift and
why not?
And how Carlyle gets in the middle of this.
Look, I think you see she made a decision to sell. Now they own it. I think the simple answer is you got to convince David that she's an American icon, no different than the Magna Carta, the Washington Monument, and that's what he does. He solves those things.
Right. And he should do what? He should do what? He should call up Scooter Braun and say, look, you're going to sell the rights back to her at a discount?
This feels like an unwinnable situation for all parties. She is a beloved public feature who has a tremendous amount of support, so I'm sure they can work out a deal somehow.
Is it bad for Carlyle? Does it matter?
I think this is just constant noise. I think this is an asset class that just is surrounded by kind of constant noise, and it's always easy to find sort of the negative angle on why private equity is bad, why private equity is evil.
So let's talk about that, because in this campaign season, it's just starting to begin. It's not, by the way, nearly where it was. You know, when Mitt Romney was running, private equity was, you know, the worst thing rolling.
Yep.
Now I'm not sure we're at that stage. I don't know if you think it's different.
I think it's a little bit different. I think the asset class has continued to get a lot bigger, a lot more mature. It's impacting more businesses, more people. And so I think it's just becoming more of a fabric.
But reputationally?
Yeah, I think reputationally, I think that bigger, that scale, that maturity helps sort of smooth out the reputation.
But the danger here, by the way, is, you know, if Elizabeth Warren, some of the plans that she has announced were to be put in place, it would effectively end the private equity industry as we know it. Am I wrong?
Oh, I think if you sort of take those things literally and you put those handcuffs around the asset class, it would provide, you know,
and just to
huge challenges.
Put a fine point on it, one of the things she's proposing is that if, for example, one business were to go out of business, to go bankrupt, you'd have to support it using the other funds, correct?
Right.
And that's sort of the biggest shift.
Yeah.
What is the industry trying to do to push back on this?
Well, I think the industry overall has been its kind of own worst enemy. It doesn't have great data. It doesn't put that data out. I think one of the things that we've been trying to do with this market overview is bring real data to the discussion and talk about what does performance look like, what does risk actually look like, how aggressive are people spending or not, to try to actually bring a
So how does this data, though, get at the fundamental question? And we had this, by the way, we had a congressman on from California yesterday. Yep. We were talking about the retail industry, and he had a list of the 600,000 people he said had been lost their jobs under private equity in the retail sector. Now, I said, look, that's diabolical because the retail industry has been decimated across the board.
Correct.
Long before private equity industry showed up on the scene. Having said that, do you think there is real data that shows that private equity is not doing the buy it, strip it, flip it model?
100%. Because we all talk about this every day. Things are super expensive. So there's no way you're buying super expensive assets today, trying to then rip out value rather than creating value, or buying down your purchase price by laying off a bunch of people and then trying to go sell that asset. The math just doesn't work. So the reality is that people are paying pretty high prices for businesses. The reason why hold periods are actually so much longer is because they actually have to grow their way out of that high purchase price, and then they ultimately sell it. And so the vast majority of data shows that private equity absolutely a net job creator, and that the bulk of the return of the asset class are coming from growth.
You would, this statement, it's an immutable fact that the net effect of private equity on society over the last 50 years has been a positive net effect.
I would agree with that. And the data supports it.
Fact? Well, I don't know. We're going to hear it's not.
We're going to hear anecdotes. I think one of the problems with the asset class is that we sort of talk about it in terms of exceptions. We talk about this one company, this one company.
Right.
And look, bad things happen.
Would you say that's an immutable fact?
That it's a benefit?
That it has been over the net, it's been more of a benefit than a negative for society over the past 50 years.
Look,
private equity.
If you
true or false?
I want to say net benefit, but
then say it.
No, but I'm not. I can't tell you it's 100% clear.
I didn't say it was. I said net. It could be 51%.
So if
how about 50.1%? Can I get you?
I'll give you that.
Okay, thanks.
To me, the question is if you believe in capitalism and you also believe in Darwinism, which is what then you'd say it's net benefit by default. And it's pushed companies.
You might say
that
it's better to save 60% of the jobs than 0%.
And that's the fundamental question. And I don't know the answer, but I want to think overall it's benefited.
Do you think that the failing businesses that are in the portfolio should be subsidized by the ones that are working so that there's no clearance. The things that don't work, that don't operate competitively should be allowed to exist, like over in Europe, where
I'll tell you what my only hesitation is on this.
It's on the debt.
My hesitation is in the debt. My hesitation is in the fact that there have been so many companies that were. I mean, look, my beloved Toys R Us. You could say a lot of things about the retail industry being under the fire, but the reason why that company was put in the position it was because the amount of debt the private equity took on to buy it. Had they not had that debt, I think Toys R Us would be part of our life today.
So
go back to the numbers.
There's good private equity and bad private equity.
And the rogues gallery of billionaires, there are quite a few that made that billion in private equity.
Sure.
So the money came from somewhere. Maybe it could have gone to, maybe income inequality wouldn't be as bad if some of these.
Restructuring can be a good thing, but if
Look,
you load it
it can be, and it has been.
Yeah.
Sometimes private equity has done fabulous things. That's why
Other times they've lined their pockets on the backs of the
and then left the business to flail.
Look, the other question is, do it this way. The amount of rent, if you think of private equity, as rent seekers, the amount of money that they have made relative to the profits of some of the companies is shocking. So you say to yourself, how did that money get moved from one place to the other? And from a societal perspective, is that a good thing or a bad thing? These are questions.
Let Eric answer. What about that, Eric?
Yeah, look, I think why is the flow of capital so extreme coming out of other asset classes into private equity? And the answer is pension funds, sovereign wealth funds, banks, insurance companies.
They're
smart people.
They're smart people.
They're looking at net performance.
Yes.
And that net performance has been better to feed their beneficiaries than they're getting in any other asset
100%.
class.
So are they skillful business managers, or do they know how to layer debt on and game the system?
Probably a combination of both. The problem is that life is not black and white. It's somewhere in the middle.
And it's hard to paint with such a
Not all
broad
players
brush.
are equal in this.
Right. You've got thousands of practitioners today, thousands and thousands and thousands of fund managers around the world, all of them kind of pursuing the asset class with very different styles.
Right.
It's no longer a one-size-fits-all asset class.